Resource combinations.
Acquisitions are a means of managing the resources available to firms, and improved M&A performance often depends on an interdependence between an acquirer's and a target firm's resources. 12 Research suggests acquisitions that enable acquirer and target strengths and weaknesses to offset each other are most likely to create value. 13 In the case of knowledge integration, positive outcomes can be expected for firms in related industries. For unrelated acquisitions, the negative impacts of dissimilarity increase as knowledge becomes more dissimilar. 14 Acquisition strategies for resources either involve supplements, obtaining more of a resource, or complements, obtaining another resource that combines effectively with resources the acquirer already controls. 15 Although a strategy based on supplements results in adding to the resource base, a drawback of such a strategy is that resource redundancy following the combination of firms can lower performance. 16 In contrast, a strategy that pursues complements focuses on combining different but mutually supportive resources and can create new value. 17 For example, value can be added if an acquirer gains access to new customers and segments that complement existing product or service. 18 Complements can also provide a valuable source of asymmetry that can allow an acquirer to gain access to target resources at a price below their value to the acquirer. Although complementary resources are difficult to value, acquirers may pay a lower price compared to the potential value of a resource combination because the value of a given target varies for different acquirers with dissimilar resource profiles. 19 The value that can be obtained from a target firm varies by bidder. The offer price of different acquirers should reflect the anticipated value of each expected combination with a target. However, to be accepted, the price of a winning bid need only exceed that of competing bids. Therefore, the price paid will exceed the value that could be created in the second best combination, an outcome that should remain true even if a bid is not contested. Any surplus value for an acquirer over the price paid can be translated into higher performance. In contested acquisitions, competitors may attempt to bid a target's price above an acquirer's value in an attempt to sabotage a successful combination. If bids remain rational, winning bids can create value from the difference between the value estimated for the next best combination and the estimated value of the combination for the acquirer. The value achieved could be even higher for resources that complement one another because they often generate unanticipated benefits, such as easier collaboration. 20 This logic is consistent with early advice for acquisitions that suggested acquiring firms avoid unrelated acquisitions and select firms that complement them. 21